For the last 30 years, the global financial elite have operated under a silent, highly profitable consensus. Keep Western retail capital trapped in low-yield index funds at home, while institutional players quietly extract asymmetric returns from emerging frontier monopolies. The public is taught to look at Africa through the lens of aid, volatility, and currency risk. But behind closed doors on the trading desks of London and Dubai, a completely different playbook is being run. As we speak, a tectonic shift in global liquidity is underway. The world's most lucrative, generation-defining corporate offerings are no longer launching on Wall Street or the London Stock Exchange. They are launching on local African bourses. We are tracking a historic $5 billion energy listing, the breaking of an 18-year infrastructure drought on the equator, and a systemic rewriting of how cross-border capital flows. Most importantly, a secret gateway has just opened that allows international and diaspora capital to bypass the middlemen entirely. This is the unmapped liquidity pipeline. This is the eighth file. To understand the sheer scale of this economic coup, you have to look at a single geographic point on the coast of Lagos, Nigeria, the Dangote petroleum refinery. For decades, Western energy cartels maintained a highly lucrative extractive cycle, buying Africans raw crude cheap, shipping it to Europe for refining, and selling it back to the continent at a massive premium in dollars. Aliko Dangote didn't just break this cycle, he completely weaponized it. Having officially hit 99% nameplate capacity, this single facility is now the largest single-train refinery on earth. And now, the financial masterstroke is live. The Dangote refinery is transitioning to a public entity on the Nigerian exchange, targeting a massive $5 billion rise by floating up to 10% of its equity. This is, without precedent, the largest IPO in African history. The scale of this listing is so immense and its economic survival so vital to the region's GDP that central regulators took a step that shocked the banking world. They granted an extraordinary special waiver allowing local pension funds to aggressively allocate capital into a single private asset. They didn't just clear the runway for this IPO, they structurally tied the retirement future of the nation to its success. But here is what the international financial press is completely missing. This is no longer a localized West African asset. With the traditional energy corridors in the Middle East choked by systemic geopolitical friction, Lekki has quietly become Europe's hidden life support system. Dangote's aviation fuel exports have surged by an astronomical 770%, delivering tens of thousands of barrels of high-spec jet fuel per day straight into the European continent. For the first time in modern history, Western aviation grids are relying on an African mega refinery to keep their planes in the air. And for the diaspora, the structure of this listing contains a highly unique core. While shares can be acquired locally, the export-heavy revenue model allows the asset to pay out a portion of its returns directly in hard currency. It is a bulletproof shield against local currency devaluation, custom-built for global capital. To understand how deep this capital transformation goes, you must look away from the private conglomerates and examine the sovereign infrastructure monopolies. For the past 2 decades, East Africa's largest capital sandbox, the Nairobi Securities Exchange, has been starved of a true flagship liquidity event. Not since the historic public debut of Safaricom in 2008 has the region seen an institutional asset massive enough to fundamentally shift global portfolio allocations. That 18-year drought has officially been broken. The state has quietly initiated the blockbuster IPO of the Kenya Pipeline Company, or KPC, by divesting a massive 65% stake in a deal valued at 106.3 billion shillings. This isn't just a routine privatization asset. This is a strategic chess move. KPC is a pure, unyielding infrastructure monopoly. It commands an absolute 91% market chokehold over the midstream transit, storage and distribution of refined petroleum products from the coast directly into the fast-growing economies of Uganda, Rwanda and South Sudan. What the average retail investor fails to realize is that KPC functions as a tool booth on the region's economic lifeblood, boosting rock-solid earnings before interest, taxes, depreciation and amortization, that is EBITDA, margins of 47% and a strict mandated 50% dividend payout policy. It represents the ultimate defensive infrastructure play for international capital. But the regional strategy is even larger. High-level, late-stage negotiations are now underway between the Nairobi Stock Exchange and massive Pan-African institutional funds. The goal is to establish a seamless, digitized cross-border framework, a plug-and-play capital pipeline. Kenya Pipeline Company is merely the anchor asset. Behind it sits a highly curated queue of upcoming sovereign offerings slated to tokenize and list East Africa's most lucrative banking networks, geothermal energy grids, and commercial agribusiness giants. Yet, as West and East Africa aggressively scale their industrial energy corridors, they are running headfirst into the undisputed heavyweight champ of continental liquidity. To understand the true battle for African equity, we have to look south to the machine that still commands 80% of the continent's total market capitalization. We have to look at the Johannesburg Stock Exchange. While Lagos and Nairobi aggressively scale their state-backed energy and midstream assets, the ultimate center of gravity on this continent remains unchanged. The Johannesburg Stock Exchange is not just an exchange. It is a multi-generational capital fortress commanding over 80% of Africa's total market capitalization. The JSE operates on a different layer of macroeconomic stack. While the rest of the continent builds the physical hardware of pipelines and refineries, South Africa has spent the last decade quietly cornering the market on large-scale technology, automated fintech, and massive green energy infrastructure raises. But here is the structural flaw in the old guard's design. Historically, accessing these massive capital engines required navigating a labyrinth of institutional gatekeepers, high-fee Western brokerages, and restrictive local banking compliance. It was an architecture designed to keep global retail capital, and specifically the African diaspora, firmly on the outside looking in. But as we cross into late May 2026, the plumbing has completely changed. The explosive rise of digitized Pan-African wealth infrastructure like DABA and Zcrest has created a direct bypass. Consider the raw macromechanics. The African diaspora currently channels over $5 billion annually back to the continent. For decades, that immense liquidity wave was restricted entirely to consumption and local real estate. Today, that capital is being weaponized. Through these native digital gateways, the diaspora can now log directly into primary equity markets. They are no longer just sending money home to build houses. They are acquiring the apex monopolies of the continent's new energy grid, collecting hard currency dividends, and buying a seat at the table of the largest industrial boom in modern history. The machinery is live, the assets are priced, and the liquidity pipeline is open. But when you open the floodgates to global capital, you unlock a completely new set of systemic risks. To see the final verdict, the hidden traps of currency volatility, and exactly how to position your capital before the September opening bell, we have to look at the final cost of the African dream. Let's be entirely candid. The corporate empires we've unmapped in this file are not guaranteed wins. When you bridge the gap between global retail capital and frontier monopolies, you enter a high-stakes ecosystem governed by brutal macroeconomic laws. If you choose to deploy your capital into these primary offerings, you must look past the hype. You must actively factor in hidden friction points, local currency volatility, changing central bank interest rates, and the raw regulatory compliance required to successfully repatriate your dollar dividends back to the West. But for the elite tier of investors, the ones who understand how to read a global balance sheet and time a structural shift, the risk is entirely asymmetric. The old patronizing narrative of the continent as a passive bystander in global trade is officially dead. In 2026, the plumbing of global finance has been permanently rewired. The empires are being built, the equity is being listed, and the gate is wide open. The only remaining question is whether you will watch from the sidelines or claim your stake in the new map. I am your guide through the noise. This has been the 8th file. The future is automated. Subscribe to the macro file to see where it lands next. We'll see you in the next file.